By a lucky accident, I started reading about investment at the age of 16 when I was in the first year of PUC. And I happened to start with A Random Walk Down Wall Street by Burton Malkiel, second edition of those days. But all the great books that I read thereafter, this one lesson which I never tire of repeating, people must have heard it 10,000 times from me, so I'll apologize in advance. But the one lesson that I learned, which has helped me in life in innumerable ways, some of the ways in which it has helped me, I have still not been able to realize, that in life there are a trillion things you cannot control. There are a handful of things you can control. We should stop worrying about what Donald Trump and Vladimir Putin are doing. We cannot control them. Okay, what am I doing? Can I gain some knowledge? Yeah, you're all sitting here because you think you can gain some knowledge and you want to do it, and therefore you're sitting here. Can I work hard? Can I improve my prospects? Can I build up my own personal abilities so that I can earn more money? Can I control my expenditure? Can I ensure that a certain percentage of my monthly earnings goes into investment? Can I plan? Can I sit down with one sheet of paper and a pencil, make a few notes? These are things that I can control. I cannot control oil prices. I cannot control inflation. I cannot control what the finance minister is going to put in his February 2018 budget. I cannot control. So stop worrying about the things we cannot control and just focus on the things you can control. And one of the things which I realized pretty recently, not in the past, was it just happened to me because of late when I say it's several years, I've been trying to reduce stress of investors, whether it's my clients or even my colleagues in the financial services business. Especially, I say, as you grow older, you want to take some action on anything. Let it be investment, let it be not an investment matter. Ask yourself one question. By doing this, am I going to increase my stress levels? If the answer is yes, think 1,000 times before you're putting your hand there. If the answer is no, you can examine it a little more. So decreasing stress, we have people age 60, 65, in retirement they come and ask us, can I do this? I'm thinking of doing that. And I can just see the red lights flashing. Not just on risk. Simply this man is going to increase his stress levels. So we give them any number of other suggestions. Join a library if you like reading. Do some social service for some time. Okay, take a part-time job where you are not saying, but that's positive stress. Stress can also be positive. Where you like what you're doing, you're working hard, but you like it, that's fine. It's the negative stress that kills us. Where we consider, oh, this is a torture. When you use words like that, this is a torture, yes, it's negative stress. So in that context, when we stop worrying about the trillion things that we have no control over, actually what we are doing is, to that extent, we reduce stress. So now let that be. I can't do anything about it. So let that happen in the background. Let me work in the few areas where can exercise some control. So this is also beautiful, and in the context of investment, John Bogle is saying, the key to fund selection is to focus on not the future return, which nobody can control, but there are things you can control. Risk, cost, time. These are things that you can control. The Financial Research Corporation conducts research for industry insiders. This is a very, very important piece of research, and John Bogle gave it to us. These people are conducting research. Be very careful for whom they are doing, who are their clients, not the general public. This is for people inside the investment industry. This is what we call the official secrets that he's spilling. One of their most important studies was to determine which of 11 common predictors of future mutual fund performance really worked. Even the poor sods who are in the mutual fund business, when they study for their exam or whatever it is or get their training, people will talk about R squared, Sharpe ratio, all these things. This is what's going to determine, this is what's going to determine. Let's examine that now. The predictors were, number one was Morningstar rating. Morningstar is the world's most renowned website for mutual fund data and studies, and they've got this 5-star, 4-star ratings. Next was past performance, how well or otherwise the mutual funds have performed in the past. Expenses, costs. Turnover, the churning. Manager tenure, how long a particular fund manager remains with that fund. Sales, of course. Asset size. Alpha. Alpha is supposed to be the value generated by a fund manager over and above what the asset would have normally produced. Which means it's a direct calculation of a fund manager's skill. By that person's skill, how much more return was he able to produce than other people would have got. That's called the alpha. The beta is the volatility. How much does the fund fluctuate with reference to an index? If the beta is 1.2, that means if the stock market has risen 10%, this fund will rise, the fund value will rise 10% into 1.2, that is 12%. If it falls, the fall will be greater than the market. So its volatility is greater than the the stock market as measured by any standard index. Standard deviation, another concept along the same line. How much do the prices deviate from a particular mean, from a particular path? The Sharpe ratio, and the Sharpe ratio is, it attempts to determine how well the return of an asset compensates the investor for the risk taken, risk adjusted return. The asset with the higher Sharpe ratio gives more return for the same risk. So if those figures are higher, you're supposed to get more, it's better. It's better for you as an investor. This is what the Sharpe ratio is. So these were the 11 different commonly used predictors, and the mutual fund industry itself, in a rare moment of sanity, wanted to know, what really works in mutual fund management. And the answer was, the study's conclusion, the expense ratio is the only reliable predictor of future mutual fund performance. So if your costs are low, that particular fund is likely to do better. Once again, the details are in the book Common Sense on Mutual Funds by John Bogle. This is also taken from there. It's only that. Nothing else is a reliable predictor. That's why I said the surest way to top quartile returns are bottom quartile expenses. The grim irony of investing then is that we investors as a group not only don't get what we pay for, we get precisely what we don't pay for. He's really twisting the language here to convey the point. So if we pay nothing, we get everything. That's why I said, when I tell you the index BSE Sensex moved like this or S&P 500 moved like this, yes, it's all very nice, those figures are correct, but you didn't get that return because you didn't invest there. If you had invested there, it's not that the New York Stock Exchange would say, please come and give us money and we'll give you without any cost. It would be through a mutual fund, there would be the cost. So that's the starting. You don't pay anything, you get everything. But you have to pay something. Therefore, you have to keep that down. It's only common sense, he says. So this is also a very good way of putting it. The more the managers take, the less the investors make. The surest way to top quartile returns is bottom quartile expenses. So costs are very, very important. In fact, if you read Common Sense on Mutual Funds, I had a bright student with me some years back, I think 2003, 2004. So this guy said, now give me one difficult book. I said, not difficult book. The good books are actually not difficult, they are simple. But take this book and read Common Sense on Mutual Funds. He read it from cover to cover. Then he comes back to me and says, yeah, I read this book. I said, how was it? 400 pages. But from page number 1 to page number 400, only one thing I learned. I said, what's that? That you have to keep your costs down. I said, congratulations. You learned it well. You learned the lesson well. That's the only thing in the whole book. Believe me, if you are ever going to read Common Sense on Mutual Funds, from the first, maybe from his foreword to the last page, it's only on costs. He is only talking about costs. But he examines it from more than 360 degrees, if that were possible. And different examples, different studies, different things. That's the driving point. That's the driving point. So, it's a very important point also. As you can see here, simple example of you invest ₹1,00,000. I've taken this period of 35 years because most people's working life, especially employees, would be around that. Start in your 20s, mid-20s, maybe after post-graduation, retire at around 60. Your 1 lakh, if it is at 10% compounded annualized, you will end up with 28 lakhs. This is not an SIP, this is a lump sum. Lump sum 1 lakh, go to sleep for 35 years, wake up, you find it's 28 lakhs at 10%. At 11%, the figure is different, 38, and at 12, it is 52. Now, take this figure of 28 and take this figure of 52. It's a solid difference. 52 versus 28 is a solid difference in final value. But if you take what is the return, one was 10, the other is 12, that's all. For just a 2% difference, you can end up with a very big hit to your final value. And you have to examine and see whether that 2% had anything to do with costs that I could have managed. So this is a very, very important point. David Swensen, who is the Chief Investment Officer of Yale University, he also sat with Burton Malkiel and John Bogle on Vanguard Mutual Fund Board of Directors. He says, the fund management company gets paid. The fund manager gets paid. The investor pays. David Swensen, if any of you are interested in institutional fund management, he's written a couple of brilliant books. One of them is this, Pioneering Portfolio Management, an unconventional approach to institutional investment. People like me mainly function, even Deepak, mainly function in personal investment. We don't take institutions. We don't want institutional clients also. But nothing like reading to understand what are the kind of issues that are important when you are managing other people's money, institutional money, trust money, religious trusts, charitable trusts, all this kind of thing, public money, so to speak. A brilliant book by David Swensen. He's written a couple of books, but this would be on institutional management. Very, very good book to read. I don't watch TV, but even somebody like me who does not watch TV, we have seen mutual fund statutory warnings. So this I'll give you only for your reading. To edit what you're saying, they have not slowed down. They were made to slow down. I agree. SEBI slowed them down. So probably now Usain Bolt may win. Now. Okay. Yes. While I said we don't handle institutional clients, a little bit of general knowledge here is very, very useful. A lot of people are unaware that mutual funds are allowed to be invested in by trusts. It need not be only private beneficial trusts. That, of course, there are no restrictions. We are talking about associations, cooperative societies, religious trusts, charitable trusts, people having the 12A income tax exemption. So a lot of people are totally unaware of this factor, that they can be invested there. So I'm not going to explain this, but here is the law that permits them. There are these 12A entities, they are granted tax exemption, to make it very brief. And under the Income Tax Act itself, they say that 12A entities can invest in, as you see it there, any other form or mode of investment, among others, or deposit, as may be mentioned in 17C of the Income Tax Act. And 17C says that you can invest in units issued under any scheme of mutual funds referred to in another portion of the Act. So hide and seek goes on, but ultimately you come to the last point where you are allowed to invest in a mutual fund registered under the SEBI Act. So lot of these people hesitate. Can we not? A religious and charitable trust, for example, cannot invest in equity shares. You can invest in an equity mutual fund, the same thing but through an equity mutual fund. So any kind of mutual fund also can be invested in under these laws. Now, this is general knowledge. Even let's say you don't know it, you can ask a good chartered accountant and he will tell you. But if at all any of you are either involved in the investment of either trust money or public money, we have to really be a little careful of how we manage that money. That's why I said David Swenson puts it beautifully. How do you manage public money? Let me very briefly tell you my ideas, right or wrong. A lot of people have one standard for managing their own money and another standard for managing money that is not theirs. A lot of people ask me, why don't you have institutional clients or why don't you want institutional clients? Even in a public forum like this, I will bluntly say for two reasons. Number one, whether we like it or not, there is a lot of underhand dealing and corruption in even religious and charitable trusts. The people sitting there who are in charge of investing money, they will want a pass back many times. And they will give it to somebody who caters to their pleasures the most. We have seen this, other people have told me, and first hand I know that these things happen. The second is, see, in my line of work, there are a lot of people who are with me 30 years back. Now their children are with me. It's a long-term relationship. It's such a long-term relationship. It even transcends generations, from one generation to the next. What happens in institutions is, there's a guy who's in charge of the investment. Let's call him the chief investment officer. The chap's salary may be 40,000-50,000 rupees a month in a maybe city like Mangalore, maybe a little more. But sometimes he has the power to write 10, 15, 20 crore checks. So that is a heady narcotic. In fact, narcotics need not be only substances, actual substances. Okay, you have heard of opiates or anything based on opium. There's another opium. The spelling is a little different. You know what this is? Other people's money. This is also a very powerful narcotic. And you can not only get high, you can remain much higher than for a longer period than on actual narcotics. So they consider themselves experts. They don't listen to good advisors. Second thing is, let's say you were able to make some headway and advise that institution correctly, and the guy in charge there knows what's happening and listens to you, and he says, okay, you're an advisor, I believe you're a good advisor, I'm going to listen to you. Some 3 years or 5 years later, this guy gets transferred. There's a new guy sitting there. He may not listen to you. You don't have the kind of intergenerational relationships that you'll have in families. So for these reasons, I do not accept institutional grants. I just don't like it. But I have no quarrel with anybody who wants to manage money, and there are good people who can also know how to lay down the law and say, yes, either you listen to us or we don't want your money. That too is fine. Such people are really good because it's an eye opener for them, a new. But The important thing I'm talking about is, when it comes to managing money like this, the most important thing is ethics, nothing else. Because the money is big. For distributors and for agents, the rewards are big. The commissions are big. There can be 20, 30, 40, 50 crores investment at a time is not unheard of. Now, the first thing that you have to do as an ethical advisor is you have to always start at a zero risk position. You should never risk public money, which means if it is mutual funds, you are permitted to invest in equity funds, in sector funds, in debt funds, in balance funds, in whatever. Yes, I agree. But I would place the money in the safest of debt funds, namely what we call in India liquid funds. This would be my starting point. So the principle would go only into this. If at all it's long-term money, there are 2-3 ways of handling it. First is you can give what's called a capital appreciation transfer. Only the income that you are generating on this principle goes into an equity fund on a monthly basis. So whatever happens, there is no threat to capital. And my end point would be the zero risk systematic transfer plan, where if you put, let's say, 1 lakh rupees into a liquid fund, you transfer 1%. That is 1,000 rupees per month. Very, very conservative transfer. 1,000 rupees per month out of this 1 lakh. So only 12,000 rupees in a year. Even in 5 years, only 60,000 rupees. And this does not remain 40. It grows because there is a income coming in on the debt part of it. The chances of a loss to capital are so minimal as to be laughable. I'll give you examples later in this presentation. This would be the point at which I would end. Here I would start, here I would end for a institution. So, especially where it is public money, where it is religious and charitable money, nobody should be able to point a finger either at you or the chief investment officer there that you took a risk with the public money. We have to be absolutely safe. By all means, let's go to equity. But let's go to equity in such a controlled manner that even midway, if they have to liquidate everything, nobody can point a finger and say, you lost money. They can say, okay, your returns were not good. Fine, plead guilty, no problem. If you had put in bank deposits at that time, it would have done better. You put it here. Yes, all that I agree. But I did not lose the principle. If 50 crores were invested, you can take back 50 crores. Generally, you will take back something more. So this is very, very important. And the kind of wrongdoings going on in the whole mutual fund industry for this, amazing, amazing. Just to give you an idea about, this is the ethical point. I'll just give you one example and we will, this is a good place to stop also. Back in 2009, I think, I get a call from one of the CIOs of well, let me not go into details, of a institution that does not have, what is that called, to pay income tax, but commands plenty of money. So, when can you come and see me? I said, first, who are you? He says, I'm so and so. I said, you're not a client of my office and I don't go and see people. If people want, they take an appointment and come here and see me. Almost 20-second silence on the other line. Nobody has spoken to him like that. Well, there will be about, at any given time, 10 mutual fund distributors licking his boots. So he said, no, we are having some problem with our investments and we wanted to consult you. I said, I don't handle institutional business. And you are having some problem, you take an appointment and you come, I'm willing to see you once, I'll see whether I can understand that problem. He had to wait for 5 days for an appointment. He waited and he came at that time. And of course, it was a royal mess, but among one of the things that I can never forget was 25 lakhs has been invested by a distributor into an ELSS fund, Equity Linked Savings Scheme Fund. Now the Equity Linked Savings Scheme Fund understand this, is a tax saving fund. You save tax under section 80C. Today, of course, the limit is 1,50,000. Let's assume the limit was 1,50,000. So I'm looking at this. I said, you're the chief investment officer. How did you allow this? He's saying, no, told that you get good returns, equity fund. Equity fund, I know. You don't even know the difference between a normal diversified equity fund and a tax saving fund. It's an equity fund, I agree. First of all, when you put money into a tax saving fund, your money is locked for 3 years. For 3 years, you cannot take it out. Doesn't matter who puts it. Second, even if you want tax saving, the maximum tax saving you are given is only 1,50,000 per year. Third and most important, for whom am I putting this money into a tax saving fund? It's for a religious and charitable institution, in that case, which is exempt from the payment of tax. Okay, that's the most interesting point. They did not have to pay tax. There was no question of tax saving. Why was this put? Because of this 3-year lock-in, on these kind of funds, the distributors get a far higher brokerage. Now, when the markets come down, liquidity is a cardinal principle of investment. Always there's a trade-off. If I want a tax benefit, many times I should be prepared to forego liquidity. That's why even in your PPF, your withdrawals can be only after 7 years. In an ELSS, it is after 3 years. Yes, if I'm getting that benefit, yes, I'm prepared to sacrifice liquidity. Here there is no benefit. The benefit is irrelevant. I'm a tax-free entity. And I'm still blocking 25 lakhs into an ELSS fund. So you understood the difference between, okay, what is the level of ethics that somebody must have in advising institutions, and what actually goes on a good deal of the time in real life.